The dollar just goes down and down and down. There's no particular limit. The limit is zero. We're not getting to zero anytime soon, but there's no reason why the dollar couldn't be 7 milligrams, 6 milligrams, 5 milligrams, 4 milligrams, which would be, what is that, $7,500, $7,600 in gold. In silver, the picture is even more extreme. We see a rise in co-basis while we see rising price.
So we're already in PHYS, which is like a physical gold ETF. I think it's got good potential. I think it has potentially more than GDX, as we've seen in my recent updates for this last push, because gold stocks could get stuck in a bit of a sell-off and have some downward pressure. So we're already in the gold play. We've already locked in partial profits, and we're in the middle of the trade. We're already in this.
In times of market uncertainty, investors often seek assets that can withstand turbulence and still offer opportunities. Precious metals have long been a key refuge, but the dynamics around gold, silver, platinum, and even baskets of metals are showing unique signals today. With the US dollar steadily losing purchasing power and global markets facing heightened volatility, these assets are again moving into focus for those looking to preserve wealth and capture upside potential. ChrisVermeulen, a market strategist renowned for his technical trading insights, and Keith Weiner, an economist specializing in monetary science, bring complementary perspectives to this discussion. Their analysis highlights not only how gold and silver are behaving now, but also what history, particularly the 2007 and 2008 cycle, teaches us about capital flows during downturns. Gold is showing strength, with ETFs like FYS offering a physical-backed play that can outperform mining stocks, which often get dragged down during broader equity sell-offs. Silver, historically more volatile, has the potential to surge further when money rotates aggressively into defensive assets. Platinum and other metals can provide short-term bursts of performance, but they carry higher risks on the downside. For investors who prefer diversification without trying to pick winners, instruments like GLTR, covering gold, silver, platinum, and palladium, offer an efficient way to participate in a precious metals rally. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
So let's get into some interesting charts. Let's go back to the 2007 timeframe. We talked about this the other day. We have the S&P 500, this is on the top left chart, 2007 market high. Stocks put in a high. Gold started to pick up and shoot higher. Just before, the last final major push to the upside, gold miners came to life. And we're starting to see that right now. This is on the right-hand side here is where we are. Gold's starting to scream higher. Gold miners have now come to life. Everybody's moving into the space for bigger moves. And so that tells me that I think we are on the last month or two of the precious metal space going higher, and that the stock market could put in a top at any point here over the next month or two. But somebody asked, they wanted to know, how did silver perform in 2007? So let's just zoom forward a little bit here. If we go to the stock market, sold off 55%. Gold pulled back about, this doesn't show the wick highs or lows, but about 30%. Gold miners fell 65%. Well, let's see how silver performed. This is one, a couple members actually wanted to see this. So silver, percentage-wise, I just have to go back to the same time frame here. So we go back to 2007, and you can see, here we go. So gold shot higher, continued to run 32%. Even as the stock market sold off, we saw gold and silver move higher. Percentage-wise, silver had a very nice run as well. It had a bigger run of 41%. So again, this is where physical metals can do really well. We talked about how gold miners could move about 18%. The last time they moved 18%, and that's because they're stuck in the stock market. And as we know, when the tide goes down, when the stock market goes down, it's going to mute the gold miners a little bit, because they're a stock in the stock market that's going down. That's why you want to go physical and catch the moves to the upside. Now, they also wanted to see what platinum did. Let's take a look at platinum for that time frame. Platinum. And of course, I'll have to go back to that window here. If we go and take a look at what platinum did, Platinum, again, shot higher. It got all the attention, or got a bunch of attention here. Somewhere around here, we saw a big move in platinum, moved about 50% to the upside before eventually rolling over, and it sold off about 63%. So as you can see, these things are not safe to hold as a long-term defensive safe haven play. They are not a safe haven play. They are a defensive play that when money's flowing out of the stock market initially, money goes there to protect it. But then usually money, exits pretty much all asset classes, and then we see these big corrections. So gold's got quite a good upside potential and a very limited downside. Everything else is usually 50, 60, 70% downside is what we saw in 2007. And it might not drop that much this time, but overall just they are a lot more volatile. But there is potential to squeeze out a bit more percentage in these other ETFs. Now there's a way to take advantage of this. I've talked about it several times, but maybe not in the last couple of months, is GLTR. This is a symbol here. This is a precious metals basket. And so if we take a look at it, I'll zoom way out so you can see what it's done. It peaked out. So this basket here holds gold, silver, platinum, and palladium. So this gives you the basket of all of them. So you don't really need to focus too much on which one is going to do well. You can just buy this one ETF and you get to play them all. Now it's heavy weighted in gold, and then the second heavy weighting is silver, and then some platinum, and then some palladium. So it's not equal weighted across them all, but this gives you the whole precious metal space, or the core precious metal space, in one play. And is kind of an interesting play. And I've mentioned this before. It's kind of that really kind of passive, no-brainer type of play if you just want to get into precious metals as a whole, and you can play this during a precious metals type of rally. Another quick question was, Bill, what do we move into when we move to cash? Now this is an ETF we move into. It looks really funky if you've never seen one of these, but this is just a 3-month treasury bill, meaning it's like a cash position. So if your brokerage doesn't pay you a good interest rate when you're just sitting in cash waiting for a trade, we buy BIL. This ETF here, more or less every day there's interest added to the share price. So you collect daily interest. If you hold it to the end of the month, all of that interest gets paid out in this purple number at the bottom as a dividend payment. So you get this cash dividend payment. And then, of course, the next month it just continues to build interest and then pays it out. And so it's really just, it doesn't matter where you buy it or sell it. If you hold it over time, you either earn interest from the daily growth, or you earn the dividend payments, which is all of the interest just paid out in lump sum cash injections into your brokerage account. So this is an easy way, a safe place to move. When you go to cash, if you don't earn interest with your brokerage account, you come here. And this is what we do with our auto trading investors, because it's a way for us to continue to grow our account while we're waiting for a new trading opportunity. Or when we take partial profits out, we move into this so that our cash is still earning a bit of growth. This is like the 4.5% growth, really no downside risk. And we get to just continue to grow our account. WR Marcus is asking about, I still have a bullish outlook for gold to move higher. And he's wondering, if gold's still going to go to 4,100, why don't we get into GDX and take advantage of that 9% move? Long story short, and I do share my answer right down here, is I'm providing what I think is the best return with the least amount of risk. I'm trying to protect our capital and still take advantage of these moves. So we're already in PHYS, which is like a physical gold ETF. I think it's got good potential. I think it has potentially more than GDX, as we've seen in my recent updates for this last push, because gold stocks could get stuck in a bit of a sell-off and have some downward pressure. So we're already in the gold play. We've already locked in partial profits, and we're in the middle of the trade. We're already in this. So getting into GDX is like, if you're already in the trade that we're in for gold, then you're kind of just taking more risk. You're jumping in more, which is fine. But I already provide the signals. And if you want to do anything above and beyond, that's up to you. I know people are trading leveraged ETFs. You're trading silver miners or gold miners. Some of you are trading platinum or palladium. You can do whatever you want. I provide the signals for the overall stock indices and metals and things like that, and what I'm doing. And then, of course, you guys can amplify it with whatever other plays you want to do there. And let's take a look.
The steady decline of the dollar is one of the most striking dynamics shaping the precious metals market today. Over the last century, the dollar has lost nearly all of its original weight when measured in gold, falling from over 1,500 milligrams to just 8.2 milligrams recently. This erosion isn't theoretical. It's a tangible indicator of the system's fragility. Gold's rise is less about sudden strength and more about the weakening foundation beneath it. Unlike speculative futures buying, which tends to be fleeting, this type of demand reflects a genuine shift in how capital is positioning itself. Silver amplifies the story even further. Rising scarcity alongside higher prices signals deep underlying demand rather than just leveraged speculation. These moves carry broader implications. Rapid increases in gold and silver valuations often reflect strain in the wider monetary system. If asset prices soar while wages and real economic activity stagnate, the imbalance fuels inequality and social pressures. The system's trajectory toward lower interest rates and inflated asset values appears intact, with consequences that reach far beyond financial markets. Let's get back to the interview.
And, people are just like, is this durable? Can gold go any higher? Because they think gold's going up. They don't realize it's the dollar going down. The dollar has made a new low. It's 8.2 milligrams of gold. Not too long ago, it was 16 milligrams. A century ago, or actually even pre-1933 was 1,500 milligrams. So the dollar just goes down and down and down. There's no particular limit. The limit is zero. We're not getting to zero anytime soon, but there's no reason why the dollar couldn't be 7 milligrams, 6 milligrams, 5 milligrams, 4 milligrams. Which would be, what is that, $7,500, $7,600 in gold. It'll get there, not immediately, but what's interesting to me is we publish this stuff for free, and people can come to monetary-metals.com and just get these graphs. We publish the gold basis. The basis is the spread between the futures market and the spot market, and it tells you an awful lot. So if you see the price blip up $50 and you see the basis moving up, so the basis is measuring, futures minus spot. And if the basis is rising and price is rising, what does that tell you? Is people are buying futures, right? And then the arbitrageurs will bring spot up as an arbitrage. So they buy spot, sell future, and profit that, that spread is their profit. So if that spread is widening, that means the buying pressure is here and the arbitrageurs are pulling up spot, but, with a lag and reluctantly. Right. So the spread widens, and you can say, okay, that buying is in the futures market. And when the futures people, that's a short-term trade because they're using leverage. And there's a real cost in that market, which is they have to pay the contango. So that's not a position that people generally hold for long periods of time. That's a quick trade in and out. If that's where the buying is, that tells you it ain't going to be durable. So, we do a lot more, science than just that, but that's a really simple thing that anybody can understand. And so the basis is kind of the measure of the abundance of the metal to market. The co-basis is kind of the inverse. It's spot minus the future, which is ordinary negative, but it can flip, is a measure of scarcity. And during all those, we call them dark years, when the price of gold was sideways to down, every time the price would blip up, the basis would blip up. Sometimes more, the basis would move disproportionately up. Like, that's not looking good. Sorry, guys, put your rocket ships away. Today is not that day. And right now, gold is the you look at the co-basis, which is the measure of scarcity, and it's almost table flat as the price is going up, which the metal is not becoming more abundant to market at higher prices, which means higher prices isn't drawing more metal in, to the market. And people are buying metal as fast as it's coming to market. Now, it could be going from west to east. There's a lot of different dynamics out of ETFs into whatever. The gold market is a massive ocean because virtually all the gold mined in 5,000, 6,000, 6,500 years of human history, as far as we know, is still in human hands. It's not meaningful to say that gold moved from this corner to this corner. It doesn't, whether it moved out of the ETFs and into, vaults, or whether it moved out of vaults into ETFs, that doesn't really, change anything. But the fact that the co-basis is table flat as the price is relentlessly rising says there's real demand, and that demand is metal, not, speculators in the futures market using 20-to-1 leverage. In silver, the picture is even more extreme. we see a rise in co-basis while we see rising price. And that's extraordinary. And that says it's highly unlikely that this is top in price. Now, today, on the 24th, the price of the metal is off a little bit. My data is always, lagging. It's yesterday's data I'm looking at. But given that data, and given that that's, rising scarcity as the price is rising, I'd say it's likely the price of silver goes higher. How much higher is hard to say, but, I feel comfortable saying a couple dollars at least, and maybe more. And we see after those couple of dollars happen, then we'll see whether the scarcity suddenly plunges or whether scarcity continues to remain elevated or even continue to rise. So very remarkable. We live in interesting times in the sense of the ancient Chinese curse, may you live in interesting times. And we also live, maybe we're getting close to that point. I remember saying, 15 years ago, the gold bugs were saying, oh yeah, I wish gold would be 5,000 or whatever. At that time, that seemed crazy, right? And I was like, be careful what you wish for. Yes, you have a lot more dollars if gold is 5,000. You may not like the world that you find yourself in with civil unrest. Imagine being in Caracas, Venezuela, and you have a brand new Ferrari. You dare drive that out of your garage. I mean, because there's people that when they see that, they'll kill you. And they'll throw bricks at it, they'll set it on fire, or maybe they just steal it and kill you, whatever. Like, yeah, you may have the money to buy that thing, but is that the world you want to be in? Because the world's not going to hold together, if the gold price is moving up too fast, because it's a crash of the entire currency regime. It's a crash of the dollar, and all the other currencies are dollar derivatives. So if the dollar's cut in half in short order, which is basically just about where we're at, right? The dollar beginning of 2024 was gold was $2,000. Gold was 16, milligrams. We cut it in half to about 8.2. That's bad. That means really bad things are happening in the world out there. And then we look at the gold price and saying, this is great. Well, yeah, if you're trading gold with leverage, you might have just made a boatload of money right now. But, and if you did, great, congratulations. But bad things are going on in the economy. And all sorts of genies have gotten out of all sorts of bottles that I don't know that they get back into the bottle. That's the big, as far as I'm concerned, the big story at the moment. I mean, I don't know how fast they're going to cut it, but for the longest time, I've been saying that this attempt at hiking rates will be abortive. In the end, all the forces that have been dragging interest rates down, and more down for 4 decades, those forces are still in full force and effect. And so we went up and we had 5% or 5.25% of that funds rate. We're now back down a bit. And so, of course, to me, it's like a comedy of two wrong sides competing to see who can be wronger. The side saying, let's have higher interest rates like inflation. They have the sign wrong. The other side saying, let's improve the economy by lowering the interest rate. They have that all wrong. And when someone says this is the right interest rate, I want to say, like, where did you get that? You have like one of those magic 8 balls you bought at Spencer Gifts in the mall. Do you have tarot cards? I mean, sheep entrails on a midsummer night, moon. Where do you get this magic number? Monetary metals, we have free market interest rate because nobody is forced to put their gold up unless they like the interest rate. And I used to joke, a lot of people would sort of treat me like, remember the old E.F. Hutton commercials when E.F. Hutton talks after people listen, Keith, what do you think the interest rate is? Or what do you think it should be? And I'm like, I want to be really careful not to bias. It's a market. And, I'm probably better situated than most to make a call and say, well, this is what I think it ought to be. But, and obviously with Murin, it's purely political. Trump wants a zero interest rate because that's going to be happy days for the real estate development business, which is his business. What should the rate really be? Who the hell knows? He doesn't know that any more than anybody else. And so this is central planning at its finest. This is the, what do they used to call it? Gosplan in the Soviet Union. The commissars would all sit around and dictate, this price for this and that price for that. But what I will say, I don't know how fast it will happen, and I don't know when it really begin in earnest. To me, and I try to limit my political prognostications because I'm no better at it than anybody else. And, you're trying to predict fickle winds and which way they might blow, in the next instant. But to me, it looks like kind of an ego match between Powell and Trump. And even though Trump appointed Powell, Powell's term is what it is, can't be fired. And Trump is trying to pressure Powell and the Fed to lower rates. And so he does what he does. He attacks Powell's character. He finds some overrun on a building, the new Fed remodel, whatever. It's like, you're an idiot, you're incompetent, whatever, your mother, all this stuff. And Powell is saying, I know you want lower rates, and I'm going to keep it as high as long as I can. He's not saying it to spite Trump, and Trump is trying to beat up Powell. And, I see that as almost a pissing match. But Powell's term is up next year. And, Trump has ways of getting what he wants, even if Powell were to stay in the Fed. He's just appointed Mirren. I think he can appoint others as they come up. And I think in the end of the day, Trump's going to get what he wants. And it's not 2%, it's 0. I remember when there was some briefing or something like that Trump was doing in his first term. And somebody said to him, what do you think of Europe where the interest rates are negative? So he says, negative? Give me some of that free money. I know what to do with it. And then there was a little bit of applause. And he's like, see, the smart people, they know what's good for them. Yeah, let's have negative interest rates here, free money. And he was serious. He thought that was great. So that's what he wants. We're heading there. And that's where economically all the forces are heading anyway, even if Trump weren't pushing for it, which he is. So yeah, I'm pretty confident to say all too soon we're going to see a return to 0 and maybe beyond. And with that comes the economic lethargy, asset prices going to infinity. So those who have, the asset owning class, especially those who own assets with leverage, will be having fantastic amounts of fun. The salaries of people whose comp depends on asset prices, which is CEOs and bankers, they're going to be loving it. And it puts downward pressure on wages and jobs. And so that was the economic miracle, if you want to call it that, of 2009 through COVID, was that sluggish economy, asset prices relentlessly melting up, a few people inordinately benefiting, everyone else just kind of muddling along, hoping to survive and live another day. And I think that's where we're probably headed.
The deeper we look into the precious metals market, the clearer it becomes that these shifts are not short-term anomalies, but signs of structural change. Gold and silver are no longer simply reflecting investor sentiment. They are acting as barometers of confidence in the currency system itself. When scarcity persists, even as prices rise, it signals that real demand is coming from those who understand the fragility of paper promises and want the certainty of tangible assets. This isn't just about protecting wealth, it's about adapting to a system where traditional measures of stability are eroding. At the same time, the interplay of interest rates, asset inflation, and monetary policy creates a backdrop of imbalance. As capital rotates, those positioned in tangible assets stand to preserve not just purchasing power, but also independence from a financial order built on debt and constant intervention. These aren't distant risks. They are unfolding right now, reshaping how investors, institutions, and even governments approach the concept of value itself. If you found this breakdown valuable, make sure to hit the like button, subscribe to the channel, and share your thoughts in the comments. Your engagement helps us bring you more insights into the forces reshaping our financial future.